they have to create a massive recession. It's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession. But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected.
In this video, Peter Schiff delves into the intricate dynamics of inflation, monetary policy, and their potential impact on the economy. Schiff highlights the risks posed by the Federal Reserve's interventions and the government's fiscal policies, emphasizing the consequences of misallocated resources and inflated bubbles. He argues that while recessions aren't deliberately caused to combat inflation, the measures necessary to control inflation often lead to economic downturns due to fundamental dynamics within the economy. Drawing parallels to historical inflationary periods, such as the late 1970s, Schiff warns of the dangers of postponing tough decisions and the inevitable market corrections. He underscores the escalating U.S. debt and deficit, stressing the potential unsustainability of interest payments on the national debt, especially if the Fed aggressively combats inflation. Schiff also addresses the prevalence of credit card debt and its implications for individuals and the financial system, cautioning against the moral hazard created by excessive borrowing. As the U.S. economy continues to grapple with persistently high inflation and mounting debt, Schiff's insights shed light on the challenges facing policymakers and the broader implications for global economic stability. Let's get back to the video.
We have to appreciate the fact that really, in earnest, it started in 2001, 2002, after the dot-com bubble burst, right? That's when the Fed first lowered rates to 1%. I mean, Greenspan made a lot of policy errors in the 90s as well, and that's kind of why the stock market bubble got as big as it did. But the policies really went to the sublime in 01 and 02 with the rate cuts that gave way to the housing bubble, which led to the 08 financial crisis. But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected. And you have to allow the market to do its job. But in the short run, that's painful because people lose their jobs, they lose money, and the voters don't like that. So there's always political pressure on the government, the Fed, to try to fight a recession when the recession is the cure. So fighting it simply makes the disease worse. But what they do is they keep creating more inflation, and it's kicking the can down the road and postponing the inevitable, a pain. But every time they do that, they make the underlying problem worse, and therefore the ultimate pain to resolve it, right, worse. And so my point is we are now at the final crossroads where the Fed has to pick the lesser of two evils. So on the one hand, it can fight the inflation that it created, that it with QE and all this, the expansion of its balance sheet, it can fight the inflation. But to do that means interest rates have to go much higher than they already are. They have to go high enough to force massive cuts in spending on the government level and on the household level. But our whole economy is based on spending right now. It's a bubble. And so they have to create a massive recession. It's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession because of the underlying nature of the economy. And this recession, which will have a housing market crash, a stock market crash, will result in a wave of defaults and failures. There can't be any bailouts like we did in 08. So when a bank fails, they can't bail it out. They have to let it fail. And they have to allow the depositors to lose money. There's no money to bail out the depositors. They have to lose. The government has to tell people on Social Security and Medicare, we just don't have the money to make the payments. We're not talking about making cuts for people in the future. The checks we're sending out right now, we don't have enough money. The trust funds, so-called trust funds, are already selling treasuries right now. Social Security already takes in less than it puts out. It's insolvent. So the government has to tell government pensioners, we can't make the pensions because we're broke. We actually have about a $3 trillion a year deficit right now, maybe closer to 4. I mean, even if they massively increase taxes on the middle class, I don't think there's enough they could do it. So they have to make these deep cuts to government spending. And of course, that's going to be very problematic for people who were counting on Social Security or who lost their savings in the bank. In fact, if the Fed really fights inflation, we probably can't pay the interest on the national debt. If the Federal Reserve allowed interest rates to rise to where the market would place them, credit card lending would stop. The banks would not be extending the credit. They couldn't afford it. There'd just be no profit in the business. There's only profit because they could still borrow at 5 or 6% from the Fed and loan to consumers at 21%. And there's enough margin in there to, eat up what
make
they
up
lose.
for delinquencies and make a good business.
But if interest rates went up to 10, 12%, they couldn't. The government has undermined the financial system with its subsidies and guarantees, right? All the bank deposits are guaranteed by the government. The banks do all sorts of reckless things because of the government that they never would do in a free market. And artificially low interest rates are a big part of that. But there are other things that the government does that distort the markets and that lead to excess consumption. Remember, we have this phony economy that's based 70% on consumer spending. And consumers can only spend if they can keep borrowing. And so they're facilitating that. And, one of the really dangerous things with these credit cards, and I've been talking about this, is, once you have so much credit card debt that you can never pay it back. Once you realize that you can't pay it back, your incentive is just to keep running it up even higher because you're just going to go bankrupt. And so you might as well go out with a bang. So if I owe $100,000, I might as well owe $200,000. It's because I'm spending money that I know I'm never going to pay back, which is a moral hazard in and of itself. Because now I want to start buying as much stuff as I can on credit because I know after I go bankrupt, I won't be able to buy anything. So I might as well buy, because when you go bankrupt with a credit card debt, they don't go and repossess all the stuff that you bought. You get to keep everything you bought, right? The credit card debt isn't secured by all the merchandise that you bought or the vacations that you took. So it's free money as far as a lot of people are concerned. So the moral hazard there is enormous as people are running up debt. And they did the same thing with student loans, and now it's even worse. I mean, the reason that college is so expensive is because the government guaranteed student loans. Before the government started doing that, college was cheap. Even Ivy League colleges weren't that expensive, and they never really raised prices. I mean, you can go back in time, maybe every 50 years, Harvard would raise its price a little bit, or Yale would raise its price, but, the price would be the same for decades. All government creditors are going to suffer more through inflation than they would through, devaluation or depression, whatever we would have if we defaulted. But the politicians would rather create the inflation because the pain and the damage will be pushed to the future a little bit, and they can always point the finger at somebody else. The government always blames inflation on the private sector. They blame it on greedy businesses. They blame it on Putin. They blame it on everybody but themselves. But there's only one source of inflation, and that's the government, and it's the government plus the Federal Reserve, working.
In conclusion, Peter Schiff's analysis sheds light on the complex interplay between inflation, monetary policy, and fiscal decisions, highlighting the potential risks and challenges ahead for the economy. By delving into historical parallels and current economic trends, Schiff underscores the importance of addressing underlying structural issues, such as misallocated resources and excessive debt, to avoid a potential economic crisis. As policymakers navigate the delicate balance between controlling inflation and avoiding recession, Schiff's insights serve as a reminder of the difficult choices that lie ahead. Whether it's grappling with rising interest rates, unsustainable levels of government spending, or the moral hazard of excessive borrowing, the path forward requires careful consideration and prudent decision-making. In the face of ongoing economic uncertainties, staying informed and engaged in discussions about finance and economics is paramount. By subscribing to channels like this one and seeking out thoughtful analysis, individuals can better understand the complexities of the economic landscape and prepare for the challenges ahead.